Joining us this morning, Wilmington Trust Head of Investment Strategy, Meghan Shue. Meghan, it's always nice to start the hour out with you. Talk to me about this call. Is this a pivot for you or not?
Yeah, thanks for having me, Carl. We've been, I think, maybe a little early on this call, and our work across macro indicators, valuation, and momentum has been signaling a preference for growth over value for several months now. And I think it maybe took some of the stress in the banking sector and a decline in rates to see that realized. But I think going forward, as we look at what's already been priced in, and maybe, a lot of the bad news, certainly what we heard from Meghan yesterday was not good, but starting to signal that maybe we're finding a bottom in terms of expectations for the tech sector. And then just growth overall, if you think about the rates picture, the Fed has committed to this inflation battle, and we know inflation's coming down. M2 money growth is very closely correlated with inflation. It's also correlated with growth itself. And as we look at the rates picture and the economic picture, I want to be looking for companies that are generating their own growth. You get a lot of higher quality as well as mega cap in there. And we think that that's really where you want to be positioning for the year ahead.
We continue to get calls from other strategists that argue, a number of things, that Q1 will mark the highs for equities of the year. It's better to be in cash for the year than in stocks. If you look at total return expected among some strategists, you clearly do not believe that.
Well, while we are, I would say, cautiously optimistic on the tech sector and we like growth over value, that's really a more pessimistic call because value is tied more to the cyclical economy. We do have a recession as our base case for this year, and we're slightly underweight to equities. But I think if you're trying to pick your spots, where we're underweight is in small cap, and we want to be allocated to large cap. So I think it's, you have to slice it a little finer. And I think there really is a lot of uncertainty out there. So you don't want to be too defensive. The consumer is incredibly resilient, maybe even frustratingly so for some of the bears. And so as we look forward, I think that we're looking at a picture where there's a lot of stress in the system. We've already seen signs of things breaking, but that consumer is still holding up very well.
I guess, Meghan, I'll ask sort of what I asked Mike Santoli, which is if the economy is set to weaken further, and even if it's not as dire as some are expecting, if the bottom line is we're going to get tighter lending standards and we have more tightening in the system and that's going to pressure the economy, why is tech holding up so well? I get lower rates are good for multiples, but eventually doesn't the recession and lower earnings impact have to catch up?
Yeah, Sarah, it's a great point. I think what we've seen is sort of almost like, and we've heard people talk about rolling recessions, I think more in the sense of the global economy. I would say we're almost dealing with a rolling recession through the U.S. economy, and the tech sector and a lot of that decline in technology, hardware, memory, consumer-facing technology has really been beaten up. And I think it's really just a relative story of having that pessimism already baked in and things showing that they're, especially from a CapEx perspective, likely to not get materially worse from here. But I think it's, maybe more than a sector story, it's really a size story. And I think that any companies exposed to smaller banks and the small cap asset class in general is likely to see more stress from higher interest rates and the continued weakening of the U.S. economy.